Hey folks, welcome to Weekend Technical Analysis Update by InTheMoneyStocks.com, your leaders in pure technical analysis, avoiding all that Wall Street hype. This weekend technical analysis update is for Monday, October 26th through Friday, October 30th, 2009. Well, folks, you're looking right ahead at the SPY chart on a 10-minute basis, each candle being 10 minutes long. Again, here you can see Thursday's action and then Friday's action, and what a move in this market across the board, up, down, left, right, whatever you want to call it. It was a wild week, and it was a wild week for other reasons as well. We got a lot of key earnings reports, some fantastic earnings reports coming out, yet the market did not necessarily react in the way you would have thought, and I really want to cover that today in this video because I think it's going to be key going into next week. In last weekend's analysis video, we talked about how the market was getting ready to kind of do some little bit of, shaking and baking, if you will, and I think that has begun, and I'm going to talk a little bit about the technicals in regards to that. But just going over the Friday action here quickly, folks, just to see what happened. The Dow was down about 110 points, NASDAQ was down about 11, S&P 500 down about 13.5, really about 1 to 1.25% across the board on the Dow and the S&P. NASDAQ bucked the trend slightly down, only 0.5%, but overall, the key to Friday was the sell-off that we saw. And what was so unique about this sell-off is that you saw the sell-off on Friday as well as Wednesday happening in the face of very good earnings reports. All right, and that's really key because what you're starting to see is a little divergence between good news and reaction in the markets. In addition, the dollar is not having as big an impact on the downside to the market going up. Now, those of you that have been watching us and really following these videos, whether you're a Research Center member or a free daily analysis viewer, you know that the market has really been a reaction to the overall dollar's movement. When the dollar falls, and here's the chart of the dollar on the daily chart, you can see the dollar is generally angled down. What's been happening? The markets have generally gone up, and that continues even on an intraday basis. Here's the intraday 10-minute. When the market, goes up, it's generally because the dollar's been down. And again, if you want to look at the weekly chart, take a look at this chart. Here's the dollar on the weekly chart, and you can see here on the weekly that the dollar topped out right here in 2009 in the first week of March. Now, what do you know about the market in the first week of March? You should be knowing it at this point. If we look at the SPY, here's the market bottoming. So again, notice the kind of opposite reaction there. When the dollar bottomed, when the dollar topped, the markets bottomed, and they've reversed ever since. And you can see this is what the markets have done. And let's go back to the UUP on the weekly, and this is what the dollar has done. So you can see there's a direct inverse proportion to what's going on here with the dollar in regards to the market. So when something starts to change a little bit here, that's really when you have to really begin to pay attention because there may be a change in character in the market approaching. Now, again, it may not be tomorrow, it may not be the next day, it may be a week or two away, but you have to start to look for these little cracks in the ice to dictate where this market's going. Now, let's go back to the spiders, and I want to discuss really a little bit about the 10-minute here. Now, the interesting thing that fascinated me about Friday's action was you gapped up on the back of those Amazon earnings, Microsoft earnings, Capital One earnings. AXP was okay, but sold off because of the market. Nonetheless, you had some decent earnings out there. The market only gapped higher into our master level. Now, our master levels are analyzed, technical basis, you name it, calculations, cycle analysis, all that stuff goes into where we give our clients, our premium subscribers, their master levels. And the master levels continue to be spot on, literally to the penny, basically, on every level we say go short here or go long here on these levels. Now, in any case, on Friday, we saw the market gapping up into our master level right here at 109.68. As soon as it hit that, it started to sell off. Now, the interesting thing about the sell-off is that it took place while the market dollar, at least the dollar itself, was beginning to get a little bit of a rise there again, and that's supposed to happen, right? That's what's supposed to happen. If the dollar rises, market's going to fall. But the unique thing about Friday is that the dollar then starts to fall back down, and as it does, the market happens to only get a small bounce, and the dollar actually goes to the lows of the day here at around 12:30 p.m. and the market, as you can see, this is the chart of the SPY. The market only gets a small bounce, and I found that unique. And let's take a look at the UUP. So again, here's the move up. Now we obviously know that the market fell down, right? And so that's right. We know that's correct. That as the dollar fell, as the dollar rose, the markets did fall. But the unique thing about the next portion that I showed you guys was that you actually came down and hit a new low of the day here on the dollar, and you didn't hit a high of the day on the markets. So that's a little bit of divergence that you need to recognize. See, here's the dollar. Look at this. It opened here, and here's where the dollar is. And take a look at the SPY. the SPY only gets a small bounce. You don't go back to the highs up here. In theory, from what we've seen over the past couple months, even 6 months or so, if the dollar's hitting a new low, you should be seeing this market actually go all the way up here and make a new high, in theory. That's really the theory that you want to go by because that's been what's working. So again, I just want to point out these little bit of divergences that you have to kind of recognize if you're following the markets on a technical basis and really on a kind of a swing trade basis, knowing where to position yourselves going forward. Again, the market coming up here, then the dollar starting to rebound, and again, pushing the markets to new lows. We basically closed at the lows of the day. Again, the unique portion of that was that you actually had the markets selling to the lows of the day here and closing near the lows of the day. That's unique because most of the last 6 months to 8 months, we've seen the markets actually slowly float up the rest of the day. The lows tend to be made early in the day, and I've covered that for you guys as well in previous free videos as well as premium subscriber videos, that the markets seem to be making their bottoms most of the time at around 10 o'clock, 10:30, 11 o'clock in the morning, and then they'll float up the rest of the day. The key is going back to Wednesday. Wednesday, that did not happen. Look at this. Here's your Wednesday. You floated up, nice little move up, and then look at the collapse late in the day, closing strong negative. Then Thursday came, and it almost was like they purposely, whoever it be, Goldman Sachs and the other players, purposely took the market and did the little bit of a piggyback play, getting all the people that thought the market was going to collapse again and really go bearish to turn back to the bullish side, reversing. You really got all the shorts to get out of the market there and say, you know what, I give up at this point. And that's good. That's what you want to see. I noticed from the sentiment in the chat room, I noticed from the sentiment all across the market that on Thursday, that's what you did. You really broke the back of the bears. And that's a perfect scenario to go off of our key master level here at 109.68 and look for more downside. Sure enough, that's exactly what happened, folks. Again, people thinking the markets were going to scream on Friday based on Amazon, Microsoft earnings, and they actually collapse and have a nice solid down day, and that's the beauty of it all, folks. Again, psychology, price pattern, time, the stuff we teach in the research center is exactly what you need to know to make yourself a profitable swing trader, investor, day trader, whatever it may be, and it continues to be that way. So again, guys, beautiful action, good volume on Friday, which is also key. Fridays tend to be flat to up days, so it really was a break in character for about 5 or 6 different reasons on Friday. Now, the key is, again, going into next week, folks. What do we need to look for next week? Are we going to look for a down day? Are we going to look for a little bit of a pause day on Monday? Monday, in general, folks, is almost in the previous month of October, we've had the 2 lightest trading days of the year. Now, this is amazing in my perception. The lightest trading days of the year have been in October, and they've both been Mondays. So you have to look at Monday and say, Monday's going to be a very key day in this market. Are we going to see heavier volume? Are we going to see a confirmation down day? Are we going to see a little bit of a move up? What are we going to see, a flat day, a pause day? What type of action are we going to see? And that should dictate, depending on what we get, what you're going to look for the rest of the week and even possibly the next few weeks. Now, again, I can't divulge what our projections are for next week and where the market's going to head soon, but you want to just follow the cracks in the ice. Let it guide you. This is a book, guys. This chart is a book. If you know how to read its language, you can tell about what's going to happen. It's like getting tomorrow's newspaper today, and that's what we've been able to do, giving the key levels, the master levels to go short, go long off of, and we continue to do so. So watch these levels, folks. Unbelievably important. Now, a couple other things I want to point out, folks. Let's go to the 60-minute chart. The 60-minute chart has our master levels on it. Here it is, folks. This is your master level and this. Now, these two levels, 109.68 and 110.34, these levels were given to our premium subscribers over a month ago. Over a month when the market was not even close to these levels were given out as possibility of targets for where you initiate shorts. And as you can see, look at this market. I mean, I just want to show you, go back even further. Look at this. The market comes up here. Where does it go? Right to this level here. That's your short. Look at what happens to the market. It dumps. We were able to short right there. Our premium subscribers were able to get that short off, make a nice 150-point drop on the Dow. Nice swing trade overnight. Then you go into this pattern. You come up. You touch our next master level at 110.34-ish right in here, and the market collapses down again. Then you go all the way back to the master level at 109.68 and look at the collapse. So if you can follow these, you can make the deals, you can make the calls on this market, you can be on the right side of the trade, and it's so, so important. The other thing I want to show you here quickly, folks, is that there was something else that told us the market was going to fall on Friday, and I want to just draw that in for you guys because I think it literally is probably one of the most important things that you're going to see today in this video. Look at this M pattern. All right, there's an M pattern. Look at the A. See the MA? So here's your M, here's your A pattern, right there, MA. Now, how did you know this was going to play out? And this is a little bit of a trade lesson for you all to monitor and watch. Well, what you're seeing here is, see the M pattern? The key to an M pattern is you want to see the right side of the M, this portion, being higher than the left. All right, so again, the general, to make this percentage-wise play out 80 to 90%, you need to see this pattern with a higher M top right here on the right side. That's number one. Number two, as it falls and creates the full M, the bounce will come in for the A. The important thing of the A pattern is that you don't want to see this area taken out. Really, the height of the M on either side cannot be taken out. In addition, where you started to decrease on the M side, you don't want to see that eclipse. So see this high pivot where it really started to collapse down here on the 30-minute? Normally I look at the 60-minute, but I'll show it to you a little better on the 30-minute. You don't want to take out the high here. Look at how that just comes up underneath it and does not take that out. That is very, very important. This top of the A cannot take out this point where you start to pivot lower, or the either high pivot of the M tops on that chart. When you have those things, this tells you there's a high percentage, probably 80 to 90%, that the market's going to roll over and complete the A pattern. So remember those rules, folks. There's a couple other keys to that, but again, we'll go over those in the Research Center. You really want to know this stuff, folks. Join the Research Center. The amount of data and the amount of guidance, the amount of education that you receive in there is second to none out there, 100% there. Go find out. Go join. We'll talk to you soon. Have a wonderful, wonderful weekend. We'll talk to you on Monday. Take care.